Good evening, everyone. If you're in New York, I hope you're surviving, or in the Northeast, this sweltering weather. I am David True. Those of you who have previously attended a NYPAY event will know me. Those of you who haven't, welcome. We try to do the best content and the best events that we can, and I hope you feel the same. Tonight should be just that. We have an absolutely stellar panel on a topic. Few could be a hotter topic. So I'm very confident you'll walk away knowing more than you did when you joined the call. And a couple of mechanical things. Please, if you're not a panelist or the moderator, uh, put yourself on mute and take yourself off camera. The discussion will last about an hour. Then we'll have a couple of breakout sessions for those who can stay, so you'll get a chance to interact, more directly with folks. And I think that's it, other than introducing the man who's running this, the moderator. And I normally call him Ed, but because of the way he's dressed, I'm going to call him Edward. So I'd like to introduce Edward Stringham and take it away, sir.
All right, David, thank you so much. My name is Edward Stringham. I'm a professor at Trinity College, and welcome everybody to being at this panel. We are going to be talking about the most exciting topic in the world, which is stablecoins. We've been hearing a lot about them in the news and politics the last couple of weeks. I'm going to just spend a minute or two giving an intro to what they are for those of you who don't live and breathe this stuff. And then we're going to start chatting with some of my colleagues, our esteemed guests, who are going to give us an overview of what's going on in the industry today and with this recent bill that was passed, the Genius Act. So just by way of background, everybody's heard of cryptocurrency. The most famous one is Bitcoin. We've got Ethereum as well. That's also very famous. Many people view Bitcoin as like digital gold, a way to invest money, and some people transact in it as well. There's other ones which I'll just categorize as meme coins. My Bitcoin friends have a less flattering word for those ones. You might lose your money in those. Those are many goofy ones. And then the third category that we're going to be focusing on today are stablecoins. And stablecoins are simply defined as cryptocurrencies that are linked to specific things, specifically, most commonly, the US dollar. There's also stable coins that are linked to the euro. There's also stable coins that are linked to gold. So if you have, I don't know the price of gold, but if you have $3,000 worth of gold, and if that's the price of gold, you can then cash in and get an ounce of gold if you have a stable coin in gold. Far more common, as we can guess, are stable coins in dollars. Now, historically, and they still exist, but there are these things which are less common called algorithmic stablecoins, and there are these complicated formulas where they buy and sell certain things to peg the price of these stablecoins to dollars, and sometimes that can go awry. What's most common, and really largely we're going to be probably focusing on that today, are stablecoins that are simply backed by a dollar or a US government security or something equivalent that is worth a dollar. So if somebody deposits $10 into this system, there are $10 sitting backing that, or $10 worth of government securities with maturity, short-term maturity, typically 90 days or less, backing these things. Now, why do people use these? Even people, I love Bitcoin. I think that's the best, the coolest one. But even people who are interested in Bitcoin often will use stable coins as a means, the rails to get into the cryptocurrency area, to start transferring their dollars to something else, to start buying Bitcoin. Other uses of it, which are major, especially outside of the United States, where banking systems are terrible, people don't want to have their money in the local currency where there's 20% inflation. They don't have a local bank. So a lot of people are actually using USDC or USDT stable coins, dollar-denominated assets, to actually save their money, conduct business in, pay people supplying goods to them, including across borders. There's not a good international transmission system, Forex, in Africa. So USDT, USDC, the two major stablecoins, are very popular for that. And then the third one that I'll mention, which is cool, is Wall Street. So we could think about a stablecoin as simply a token to a dollar. And if you have dollars in a system tied to a blockchain, you can buy anything you want as long as it's set up to do this. But they're currently being used by all the major Wall Street banks for repurchase agreements, for people put the money in. They're held by JP Morgan, given JP Morgan stablecoins, and then they buy these bonds, which are also held within the system, that are held by Bank of New York Mellon. And the transaction goes back and forth every single day. And the advantage of these stable coins is they're tied to blockchains. You can have what is called programmable money. And the smart contracts and programs execute the agreements very seamlessly, does it day in, day out. And so anybody who wants to have quick, fast transactions that are settled near instantly, these are very desirable. They're also having now repo markets, repurchase agreements intraday for the first time because these are very, very fast. That also frees up a lot of collateral when people don't have to wait for a day or two or three for these things to be settled. The last one I'll mention, which has been in the news, and I will turn it over to my guest in one minute, is we've read about Amazon and Walmart thinking about making their own stable coins. So up until now, there's been a lot of lack of clarity, regulatory uncertainty. And so 2 weeks ago, there was this act called the Genius Act, goofily named, obviously, but it creates a lot of regulatory clarity, which I think some of the large banks actually like. Some of the things I don't like in it actually adds some regulations, makes the markets a little bit more restrictive than they are today. So I wouldn't say it's my favorite thing in the world, but a lot of people are super excited about it. So I'd like to first turn it over to my first guest and panelist is Judy Raynarson, who is actually an expert in all the details of the Genius Act. So Judy, can you just jump in and maybe provide us an overview of some of the things that you're seeing coming out of this act and how you think it's going to be changing the landscape now and coming forward?
Thank you. And yes, I do think the Genius Act is going to have some significant impact. A lot of people see it as sort of the first time digital assets are getting legitimacy and being truly regulated, and in a way that is going to also protect consumers. So, what I wanted to do just to quickly walk through sort of what does the Genius Act say, and how is it going to work. What it does is it's, first of all, very important. It's only about payment stable coins. And in fact, they specifically say it does not, these stable coins cannot accrue interest. These are not investment products. These are products used for payments, which are very useful. I'm a payments lawyer, and in our payments side of the industry, it is going to have significant repercussions. So it only affects payment coins, and it allows certain entities now to issue payment stable coins legally and under federal and state jurisdiction. Only persons formed in the U.S. that are a subsidiary of insured banks and have been approved to issue payment stablecoins by a regulator can issue them, or federal qualified payment stablecoin issuers can be non-banks. And then there's a way for state qualified payment stablecoin issuers that come under the laws of the state. And so there's sort of three different buckets they come through, but it's open not just to banks, but to non-banks, which is important because in some other jurisdictions, they limit this only to banks. So allowing, this is why, an Amazon or or other non-bank companies can now be in this space if they meet there are lots of requirements. So the one thing they have made it clear is that the OCC is going to regulate federal qualified stablecoin issuers. State qualified issuers that have less than 10 billion can be are regulated by their state, but only if the federal authorities approve. And then over 10 billion state qualified payment stablecoin issuers are expected to transition. So there's one of the overriding, as you read this legislation or this act now, is there's a lot of distrust by the federal regulators and legislators over what the states can do. They want to verify, they only allow you to have a state regulator if the state laws are substantially similar to the federal laws. So there's lots of strings attached. They have to recertify every year. But if you become and you get approved to be one of these payment stablecoin issuers, there's lots of things you can do. You can issue stablecoins, you can redeem stablecoins, you can manage the assets, custody them. But in order to do this, you have to hold reserves on a one-to-one basis for in U.S. dollars, and a lot of people say this is, a very straightforward way that the government's going to try to build up its U.S. dollars, its U.S. dollar reserves. There's also a lot of to get this license to issue payment stablecoins, you've got to meet a lot of requirements that anyone who's familiar with money transmitter licensing will see that that's really pretty similar. You're going to have you have to not no integration. You have to have segregated funds. You have to have reserves. You have to have risk management. You've got limits on requirements for liquidity and capital and AML. All those things, they'll look very familiar. There is a provision allowing foreign stablecoins, but again, only with approval and only if the foreign framework is substantially similar to the U.S. framework. But there is some interesting exemptions. If you self-custody your stable coins, there's an exemption for that. So I'm not going to, this is a very lengthy piece of legislation. I'm not going to go into it, but it's just important for you to see it opens the doors for non-banks to issue stable coins. There's regulations in place, and it is really just for payment products. I'm just going to see if there's anything else.
Great. Yeah, let's get in some of our other panelists, and that was excellent, Judy. So we'll have some follow-up questions for you. I'd like to hear more about the collateral behind them and all that. Next, I'd like to invite Sarah Ellison, who is a consultant. I know that you're probably interacting with a lot of firms who are interested in this area. Sarah, I wonder if you could tell us what you see some of your clients currently doing, and if they're talking about bringing on new products, what are the things that you see people talking about here on the street?
Yeah, thanks, Edward, and thanks to everyone for joining today. It depends on the client, right? And I think a lot of people are suggesting that stablecoins can be the demise of a whole bunch of different swaths of our financial infrastructure and our financial system. And I think rather than being the demise, I think it actually is creating some pretty interesting opportunities for both incumbents and for the crypto natives or digital asset natives. We've been working with a lot of large banks. I think we see a lot of the headlines with JPMC and Citi going for a tokenized deposit in lieu of a direct stablecoin strategy. You see Bank of New York, which was very early in the custody of digital assets broadly. And then we also see some TradFi integrations. BBVA came out last couple of weeks ago, maybe with saying you can see all of your digital asset as well as your traditional currencies all in one sort of portal. So lots of activity for the large global banks. I think they are probably the most sort of the best positioned, given they serve these multinational corporations with complex trade flows, with complicated capital markets needs and foreign exchange requirements. That's where stable coins and tokenized deposits are really going to thrive. And so that you see these large global banks really coming out quite strong with views on stablecoin and how they're moving against them or moving with them. For smaller banks, is a little bit more challenging to build up the infrastructure that the larger banks have and the investments that they're making in the space. And so I think just you'll see some of the similar things with smaller banks that we were seeing with embedded finance and even with things like real-time payments, relying on either partner banks or fintechs to provide some of the capabilities that they are not able to or not desiring to build themselves, right? They want to participate, but it doesn't make sense for them to build infrastructure themselves. People have also augured the sort of the demise of the card networks with stable coins because of the potential to route around the network and get past some of the fees. I'm sure Charles will have some views on that, but I think I'm pretty excited about card linked, sort of stable coin linked cards, which allows you to sort of play in both worlds, and also just the notion that the card networks have had to battle through account to account payments and have survived that, continue to survive that, and really are quite nicely positioned to be sort of this tokenized settlement as a service provider. So a new phrase here, a TSAS provider, if you will, playing a different role than they are today, or a broader role than they are for just card payments. I think merchants probably have quite a bit to gain in terms of customer choice, maybe some cost reduction, maybe getting money faster. So that's we're hearing some interesting thing from merchants, and then consumers. Let's not forget the consumers, and they're the ones who have to adopt all of this for it to actually make sense from a retail payments perspective. They're seeing more and more passion behind that, more and more reasons for consumers to hold stablecoin, including potentially earning yield indirectly through on their idle balances, getting paid for sharing data, micro payments, micro tipping on social sites, etc. So lots of interesting incentives for consumers to maybe get us to the tipping point where people actually transact in stablecoin and then keep it there as well. Don't move back and forth between USD and stablecoin.
Fantastic. Charles Unot, I think, has a lot of specific information he can share because he is a firm which is part of the Visa network, and he's also allowing people to transact with stablecoins. So Charles, maybe if you could share what is going on right now in your industry, your part of the world, and what you see expanding as we start moving forward.
You need to come off mute, Charles.
Unmute, Charles.
Classic mistake. Thanks, Edward. So I'm the co-founder and CTO of Rain. Rain is a stablecoin-based card issuing platform. So we have APIs that our customers can use to launch card programs globally on the Visa network, all backed by our stablecoin and blockchain infrastructure. We're powering dozens of card programs currently. Yeah, we started 4 years ago, and it was really clear that one of the things that would hold back stablecoin adoption was merchant acceptance. So actually, you can send a stablecoin to anyone, anywhere in the world. It'll get there quickly, cheaply. But what they can actually do with that stablecoin was going to be limited for a while. So if you can actually make it work with the existing card networks and make it backwards compatible, you would unlock a lot of utility. And the card networks have spent decades on merchant acceptance, merchant adoption. I think it's going to take a while for merchants to actually adopt stablecoins and for there to be enough critical mass for it to be useful. So I don't think card networks are going to go away anytime soon. There might be some compression on the fee side, but there's a lot of benefits that cards provide. There is chargebacks. A lot of people are using cards for rewards, or on the other side, they're carrying balances month over month. So cards are still very sticky, and they will be for a while. And we're pretty excited about the Genius Act because for us, a lot of the adoption that we've seen on stablecoins has been in emerging markets where people are using stablecoins as replacement for the dollar and different dollar access use cases, whether it's either living in a country with volatile currency and they want to have be able to hedge against inflation, or there's a lot of remittance workflows where people are sending money back home to their home country. So a lot of the use cases we've seen are in emerging markets, and the use cases in the US have been mostly driven by speculation and trading. And now with Genius, we're going to see hopefully the adoption of stablecoins by more banks, larger platforms, larger merchants, and we'll see some of the use cases that we're seeing in emerging markets happen in the US. And another piece that we're really excited about is just the efficiency gains that happen from using stablecoins. So for Rain, a lot of our underlying infrastructure is on chain. So we're one of the first issuers to settle with Visa 7 days a week in stablecoins. And one of the things that allows is that traditional issuer will have to hold collateral with Visa Network to handle, weekend risk, holiday risk. That could be up to 4 days of payment volume. So 4 days of payment volume just sitting in a bank account, not doing much. Now we can do every day, whether it's a holiday, whether it's weekend, we can settle with Visa. So that reduces the risk that Visa has with us as an issuer, and we can hold less in collateral, and that reduces our cost, and we can pass that down to our customers and end users down the line. So we're excited about all of those efficiency gains we're going to see throughout the system because of stablecoins.
Oh, that's really cool. I wanted to ask you, so you're talking about a lot of people in other countries using these, they're underbanked. And the way I read the bill, suppose I was a big American bank, it wouldn't be too, restrictive for me. But one of the things in there which I read was if one is a foreign entity, a foreign company issuing stable coins, and one sells it to American citizens without going through all of the registrations that Judy mentioned earlier, there's very significant fines in there. So one could think about that as restriction against foreign competition, or that one can also think about that as a restriction on the American consumer of who we have to deal with. So where do what do you see in terms of this being, is it going to be pushing out certain foreign, is it closing, I guess, putting a moat around the United States, closing us off from the financial system that is crypto?
Yeah, I think the biggest still question mark of the Genius Bill is what's going to happen with Tether. So Tether is the largest issuer of stablecoins. There's 167 billion in market cap or in Tether, USDT in circulation, and they're issued outside the US, and a lot of their collateral requirements and transparency is not in line with the guidelines of the Genius Act. So yeah, it's unclear what's going to happen going forward. I think there's 3 year grace period to actually comply with the new laws, and we'll see if people in the U.S. just are not going to have access to USDT, or if Tether is going to issue a new token that is in line with these guidelines, or if they just migrate USDT to meet these guidelines.
Yeah, and the CEO of Tether just came out and said they are going to work to do everything they can. They want to be fully compliant with the new sets of regulations. And this reminds me of a question we have in the comments here from Leonard Schwartz, which says, since stable coins are one-to-one backed, are there economic risks to phenomenal success if the government hits a debt ceiling? That's the first question. And second question, is in 10 years, do we end up breaking the one-to-one rule, like going off the gold standard? I think those are two interesting questions. The first one, I would say that the US government kind of perhaps likes this act because it's requiring all the banks to have one-to-one backed either US dollars or US treasuries worth a dollar. It's 90 days or less, whatever the number is, 92 days or less. And so that's going to be a huge demand for people holding the dollar, and then also people holding government debt, U.S. Treasury. So that's one thing. Some people actually say they're just figuring out a way to deal with our high increasing debt. The first question, I think that this is not going to deal with any risks associated with the federal government. All it's going to do is say, if you're going to hold these stable coins, there is $1 behind it, or $1 worth of securities. It can actually be a repo bond security. So they know, it's there. The next question is it going to be worth the same? And my own view, I'm not fairly bearish on government currencies, is as with inflation, the value of the dollar will decrease. And so stablecoin is not a hedge against inflation the way people think some of the other traditional cryptocurrencies are. And Judy, I'm going to ask you in 1 second. Uh, uh, would there be a risk of the stablecoin issuers breaking the dollar and saying, "Oh, we told you we're going to give $1, but no, we don't really want to. Maybe you don't even have $1."
Uh, yeah, I, I think that's outside of my pay grade to kind of guess about whether we're going to break the dollar. But I did want to mention that, there is such a level of fear underlying this legislation. There was a lot of naysayers who felt that, anything that gives a patina of legitimacy to any digital assets is bad. And so that's, I think, one of the reasons that they were very hesitant to open the doors to foreign issuers, but they have included for a process to get them approved. But even then, the foreign issuers have to hold reserves in U.S. financial institutions sufficient to meet the liquidity demands of their U.S. customers. So they're still welcoming foreign, but they are making it sure that it's going to be good for our U.S. financial institutions and good for the U.S. dollar.
Great. And Leonard, I'll jump in again and say that part of the legislation, I'm not necessarily a fan of it, but which seems not too obtrusive, is it simply just says you have to have your reserves audited, every week or whatever the number is. Judy could tell me the specifics, but it's just simply saying if you have 10 stable coins, you need to have $10 or $10 worth of bonds. There was this other quote stablecoin issuer, which was probably just poorly designed. Maybe it was a scam, we don't know, but it was an algorithmic stablecoin called Terra Luna, where there was a formula where one of them was going to back up the other one. But when one of them plummeted in value, the whole thing blew up. And so that's what can happen when you have something that's overly complicated. My Bitcoin friends are always saying, look, we got to keep it simple, keep it simple, keep it simple. And so when these formulas exist such that we don't know what's behind this, it's very unclear. Obviously, everyone's favorite fraudster, Sam Bankman-Fried, had these tokens, which he was trying to prop up, which at that point was just stock manipulation. But in terms of the stable coins, the firms have been saying, including Tether, look, we've got one-to-one backing. Now, it's not dollars, it's bonds. It's government securities, which are very liquid, and the chance of them defaulting or falling below their value in the short run is very, very close to zero. And so as long as people say this is what we have and they're showing their auditors that every week, I think that's a pretty, not too onerous requirement. Tether's been claiming that they've got these 100% reserves for a long time, and I happen to believe them. But this is just putting in place a set of requirements of who are the auditors you're going to have to show this to. How are you going to be, just like, okay, open up this vault and show us your certificates here. So from that perspective, I think it's unlikely that the issuers themselves are going to say, we're not going to pay you back your dollar.
Yeah, and that's the whole point, is to protect consumers. And you're right, I think they're doing a study about like the algorithmic. They don't at this point know how to deal with it. There is again a lot of high anxiety behind this new legislation.
Yeah, and then another thing, I wonder, Sarah, if you could jump on in on this. A lot of these firms' business model is to take someone's dollar and then they give them this token, and then they put the money, the dollar, into this short-term government security. And some of these, if it's a few weeks, could be paying upwards of 4%. And so that's kind of a part of their business model. So the more customers they have, the more depositors they have, the more tokens they have, the more money they can make. This act actually specifically says, now there might be arbitrage in this situation between consumers who say, well, look, I want to shop around. I want to get paid a little bit of what the stablecoin issuer is getting in interest. And the act actually says, no, you got to have fully backed and no interest. So almost like, 100% reserve banking. I don't know if I'm overstating the case here. But Sarah, are you aware of this? And are there going to be incentives maybe for these competing stablecoin issuers to be issuing sweetheart deals? So when I was a kid, there were interest rate restrictions on banks, how much they could pay depositors. So my bank would give us a catalog at the end of the year, and we could get a free clock radio. I remember one year my parents got a new stereo. It was super cool. So this is a way of paying interest without officially paying interest. I wonder if you've thought about this, Sarah, and think that this might be likely.
Yeah, I mean, I think the act is pretty clear that the issuers themselves cannot pay interest, right? This is a payment mechanism. It is not an investment mechanism, and they're trying to make that distinction very clear within the act. That being said, PYUSD, I think is paying rewards. Coinbase pays rewards within its accounts for stablecoin held there, not necessarily issued by stablecoin. And so I think PayPal is in the process of I don't know if it's appealing or it's sort of creating its case for why this is not direct interest and is being characterized as a reward. But I think we'll see more in that regard, whether it's the direct issuer or a third party providing some sort of a reward mechanism. And maybe we'll go back to these catalogs, Edward, and all these little treats that people can get. I think it's also important to note that if you are holding stablecoin, your ability to then monetize that stablecoin is in your own command. It's in your own control through DeFi, right? Through lending, through participating in liquidity pools and whatnot. So even if you're not getting interest from the issuer, you are able to generate return on what would otherwise be just an idle dollar in your bank account.
Great. Charles, I wonder if you could jump in on this as well. And then I have another question. So with traditional credit cards, they're charging, 2%, 3% interchange fees. And, there's part of that which are real costs. And then also a lot of that just goes directly back to the customer in terms of a rebate, with the Delta Sky Miles or what have you. So in your experience, do you see two questions. One is, do you think there's going to be these quote rebates, which are equivalent to interest, which are not interest? And second, as we move in this direction, the ideal of blockchain is it's going to be having much lower transaction costs, letting settlement be near instant. And as we get to that, how do you see the equivalent of interchange fees for credit cards or debit cards or the traditional systems working?
Yeah, I think we'll definitely see these rebates or reward mechanisms happening. Where if you look at where we operate in the stablecoin stack, we are not an issuer of a stablecoin, but stablecoins we're agnostic of stablecoins. We support USDT, USDC. We work with Paxos, who's the issuer of PYUSD, to support their custom stables. And all of these issuers are incentivizing players like Rain to support their tokens and drive more volume to their tokens. And so we're getting that interest, or we're getting incentives, and we can then pass it on to the end users so that they are incentivized either through a higher reward, cash back from using the card, or we just a lot of creative mechanisms to incentivize volume on a different stablecoin. So I think we'll see creative mechanisms, even though it's not going to be direct direct interest that goes to the end user. We'll also probably see more just tokenized T-bills where you're regulated by the SEC, where you can actually gain yield on that. And I feel like on the card issuing side, I think it's going to take a while for there to be interchange compression. Because like I said before, the merchant adoption is going to take a while, where Visa and MasterCard are actually going to feel threatened enough to lower it. But where I think we're going to see savings in the short term is on right now, a lot of merchants pay high fees for like merchant cash advance, because the actual settlement time where they get paid, user swipes a card, they actually don't get paid by the card network for several days after that. So a lot of them will pay for an advance of those funds that are due to them, and they pay high percentage on that, whether that's in the teens of interest on it. And Visa is already doing stablecoin settlement on the acquiring side, so allowing a merchant to get settled much quicker than they would if they're getting payment in fiat. So that is actually probably a greater saving than dropping down the interchange for a merchant. So I think that will happen in the next couple of years. There's acquirers like NYPAY, who we work with, that are already doing stablecoin settlement on the acquiring side, which we're pretty excited about.
Okay, sir, I've got a question from one of our attendees, David Jackson. He says, issue is with is much like adoption of instant payments. It isn't useful until it's contained in a use case for someone to use. Otherwise, it remains a tool for the well-trained, experienced technologies teams to exploit. And I'm reminded of Bitcoin, especially on the early days. People, there wasn't a really easy way to use it, and I was at a conference once, and like very, let's say, super old attendee said, "Well, how do I get started?" And the speaker said, "Oh, we'll start by reading Satoshi Nakamoto's Bitcoin white paper," which is completely unuseful for someone like that. On the other hand, we've got now some of the major firms talking about it. We talked about Amazon and Walmart. Why would they be wanting to roll this out? And why would a customer of Amazon and Walmart want to use this?
Yeah,
Is it going to be too complicated?
Yeah, I think there is still a technology barrier for many people to participate in this, but we're getting closer and closer, and the user experience, sort of the interface, is getting better and better. Wallet addresses can be a lot easier to remember than the crazy string of characters that we started out with. It's the skeptical reason for Amazon and Walmart to issue is to put pressure on the networks and to say, you know what, I'm gonna push volume over here, and let's just bring my card acceptance costs down. I think the harder topic, or the harder question to answer, is for consumers. Like, what's the incentive? My cards work really well. I get rewarded. I have protections. So why would I bother? For many people, they won't, right? It's not, I don't think we're at a stage, it's sort of a tipping point where everybody in every segment of the population needs to be participating in using stablecoin. But there are increasing number of use cases. We talk about cross-border, we talk about unstable currencies. If you are a gig worker and you're working somewhere where your currency is not stable and you're getting paid, and you want that security. Those are the obvious ones. But then think about just really basic. Think about the superpowers of stablecoin, right? That you can make and receive micropayments, so payments that are less than a cent, right? Banks can't do very well with things that go beyond 4 decimal points. If we have things like rewarding creators for a certain activity, or rewarding consumers for their own data, and everybody wants to put in a micropayment, a tip, stablecoins would be very, very good to do that. They're very good for programmatic payments, right? So if there's an insurance claim, and it can be observed objectively through some sort of oracle, the earthquake that just happened in Russia, right? And then tsunami damage on the west coast of the US. That could trigger a disbursement to people who are likely impacted by and are likely to have a claim as a result of that. You can do that with stable coins. You can't do that with sort of that level of automation with traditional money. So more and more use cases. Some of them sound like science fiction, but I think we're getting closer and closer to where these can be pretty useful, and more prevalent, more mainstream.
I agree with you, Sarah, that it's the payment channels. This is really going to be able to leapfrog what's out there right now, offered by banks, offered by Visa, MasterCard. It's gonna, once you got a Walmart or Amazon, they don't actually have to have their customers accept it. They're going to be using it to move money back and forth across borders. It's going to change a lot. In fact, I work with a lot of fintechs, and most of them are licensed money transmitters. I'm already hearing that this is going to make getting your money transmitter license no longer relevant, that it's going to put the MTLs out of business. I don't think that's actually going to happen, but certainly no time soon. But I do think that just the ability to move funds without using your regular clearinghouse banking channels is going to have a significant impact.
Yeah, so definitely even among small firms, but even among large firms, sending money across
Absolutely.
borders among the large banks is pretty difficult right now, and they're getting together these different proposals to figure out how to tokenize dollars for that. So I think that would be a major way of helping the large firms as well, not just the small firms. So even if we're not using these things, our banks might be using them
Yep.
behind the scenes. I've got an interesting question. This maybe Judy can answer also. This is from Marcia. She says that Tether is behind 84% of pig butchering cases. It's like extortion, where you meet a fake fake girlfriend on the internet,
Yes.
and then you get your money extorted, and then they say, pay me, or I'm going to leak all of these salacious conversations we've had. So the question is, how does the ethics of this play out? Financial institutions don't want to be involved with a platform that is associated with this kind of activity.
Yeah, well, that's a part of the fear underlying this legislation. They made a very big point about AML. Right now, there's not the same level of anti-money laundering compliance required for non-banks, non-financial institutions. This makes all of the members, anyone who is a qualified payment stablecoin issuer, is going to be a financial institution under the Bank Secrecy Act, is going to be required to monitor their transactions, to ID, verify, have an AML compliance program. And and of course reporting suspicious activity. So I think they're hoping that this is going to be better for consumers than just dealing with a less regulated stable coin, or any other digital asset issuer. But it's that I'm sure was on the radar screen of these the legislators as they were drafting this, because they are worried about the misuse of digital assets.
Okay, this is a follow-up question from Marsha, which I think is also very interesting. So, uh, I'll just read it because it's stated very nicely. How are banks going to control the last mile? Remember hearing a story about someone went to a kiosk in the Philippines, showed their number, stablecoin number, walked away with 50,000 cash, no know your customer, anti-money laundering checks. And so the question, well, I'll have a follow-up to that is okay, we got the American stable coins. Those are regulated. We know there's one-to-one. Once I have that, can I just do whatever I want with it and send it to this person in the Philippines? And then at that point, it's gone off into the system in the same way that the dollar cash that I got from a Chase Bank is now used by some illicit person on the street.
Yeah. Yeah, the usage, I think the hope is that if a stablecoin issuer is a regulated financial institution that is moving it to a location offshore, that they are also going to know who that, like you're supposed to know who your correspondent bank is. You're supposed to know who your agent is. If you're like a Western Union with an agent who someone's going to collect, that there's an expectation that you are going to know who that person is and know what their rules are. That's this is a really important question, and there's so much rulemaking that has to be done. This is why we really just don't know exactly what is going to be required. But Marcia's question is a good one, because yeah, you can control it in the US, but you've got a inherently easy to transfer a cross-border product, and how are you going to regulate the other end of the transaction?
Right. So right now you could take a stable coin and send it through, a decentralized exchange and
Mhm.
buy whatever, Ethereum. And it's gone. I mean, it's not gone, but you don't have the stable coin anymore. I don't know where it went. Someone else has it. And then I don't know where that person is. So this is all going to be uh, know your customer uh,
That's
requirements.
Well, and keep in mind that there's already an exclusion in this for people who are moving in and out of like self-custodied wallets. So it's not going to be a complete protection. They are going to expect consumers to be wise with how they spend their money and who they send it to. But it is
Charles,
going to be, yeah, it's that's still an open question.
Yeah, Charles, I think some of your products help uh, legal immigrants who don't have U.S. bank accounts, but through know your customer and all that stuff, transact in stable coins. Is my understanding correct? So maybe can you share some of the challenges you see potentially moving forward if uh, uh, is this just going to be too much of a hassle for everybody?
It's definitely a challenge, but I'm pretty optimistic because the tools here are actually better than they are in the fiat and the traditional banking system. Like all of these transactions, there is a publicly accessible record of what address this went to. And there's tools like chain analysis or TRM where you can actually do analysis and say this address it was sent to is actually, 2 degrees away from another address that is connected to a OFAC sanctioned individual or it was involved in some sort of hack. And all these tokens are themselves smart contracts, and they have their own logic. Like USDC has in the smart contract a block list, a block list. So if there is an address that the U.S. government wants to block and freeze funds for, there's a programmatic way of doing that, and then those funds are just locked and they can't be moved. So the actual controls are better than there are in the fiat world, where you can't control someone sending a dollar to someone else and laundering it. This is all publicly available. It's all controlled by smart contracts. So the tools are still getting there, and it is a cat and mouse game with people trying to do illicit activities and criminals. But I think we actually have more potential to stop this in the future.
Yeah, I think the bank compliance officers who understand blockchain are actually a little bit excited about the extra tools and extra visibility and transparency. I think it's important to note, as Charles was laying out, people think about blockchain as being anonymous. It's not anonymous. It's pseudonymous, right? So it's attached to a pseudonymous blockchain wallet. You don't always know who owns that wallet, but to your point, Charles, these bad actors tend to get blacklisted, and to the extent that people can keep up with keeping the right people on those lists or the wrong people off those lists, then we actually have a much more transparent system, the ability to track it.
Great. I've got a couple good questions here. I'm going to throw them out. Dean asks, similar euphoric discussions were happening with instant payments in the US a few years ago. In reality, adoptions was slow due to a variety of barriers. Stablecoins face the same and perhaps more barriers. What will make stablecoin adoption move faster than instant payments? And I'm actually going to take moderator's prerogative and jump in on that, if I may. The other day, I saw this article in the Wall Street Journal, and it showed the number of stablecoins in existence in terms of measured in dollars. And it was very minimal just in 2021. And as of now, it's $250 billion. So that's not everything, but that seems like a pretty high amount. And so there are people using them. I think especially for these smaller transactions, it's much more common outside the United States. I think just for regular retail banking in the United States, I think it's pretty good. And in many other countries, it's terrible. It's not designed for the average person. And so they're just left out. So I think that's a major use case. And the other major use case, which I alluded to earlier, is these repurchase agreements. They're doing trillions of dollars of these things per month. And so this is not an abstract hypothetical. This is something that is being used right now. So to tokenize a security, to tokenize a dollar, the amount of collateral required, as Charles mentioned in his business, falls when these things are not tied up in his business over the weekend. In this case, you've got these quickly settled transactions, and the collateral is there. So I think that's a pretty cool use case as well. There's only 7 more minutes, so let's see if we can address some of the remaining questions. Okay, Lane, my student, Lane. Hey, how are you? What percentage of stablecoin users are using it for foreign transactions versus a vehicle for trading in decentralized currencies? And I would say that's a really hard question to answer. David earlier gave a statistic from ChatGPT, which is as follows: 6 to 10% is for payments, 90+% is for settlement and DeFi. The difficult thing about that is with these exchanges, there's so many transactions that are constantly settled. And if you and I trade back 1,000 trades in 1 second in a stock market or other, at the end of the day, we've only kind of made one net transaction, but the total volume is very high. And so it's kind of a little bit of an apples to oranges comparison when people say, oh, this is how much the volume is. But I guess there's no way to, as far as I know, measure it out any better. Let's see. We got 5 minutes left. Okay, Leonard Schwartz has the following. What is the rationale for adding new payment rails without replacing any. So Charles, maybe you could answer this, because people talk about traditional payment rails. They also talk about crypto payment rails. There are these services where a person can make a transaction in Africa using their Bitnob wallet, and it transmits Bitcoin to the service, gets it changed into local cryptocurrency, and nobody knows that Bitcoin is even involved. So, Charles, could you talk a little bit about when people talk about these rails, what are we talking about?
Yeah, I think one of the biggest values of stablecoins is that it is borderless. It's interoperable. It's open, so it's like a building block. You can assemble it in ways that maybe people didn't intend to, and use cases that it wasn't really designed for, because it is open and permissionless. And uh, even in the US, you have RTP, and you have FedNow. You have these real-time payment networks coming online, and in Brazil, you have Pix, and in India, you have UPI. You have all these local rails, but they're all confined within the borders of those countries. And what stablecoins give you is actually something that is borderless, that can connect these local payment rails. So it is that, maybe a competitor to Swift that is more open, that isn't confined to just banking institutions. Like, anyone could send something without having to worry about all these correspondent banks that it's going through. So it is that rail to link all these other rails. And that is value, even though there is like a net new rail being created, it is adding value on top of these existing rails.
I think we never completely sunset rails in the US.
Yeah.
Yeah.
Or maybe anywhere, right? To David's point on in the chat, I mean, there's still checks in the system. And so that tail will get smaller and smaller, and I think we'll see more and more move into digital money of some sort. And I think one of the things someone mentioned, the question earlier on RTP, and that didn't get much adoption. Why do we think stablecoin will? I think as fintech started to actually build product around real-time settlement, RTP volumes picked up. They became more useful for bill pay, for earned wage access, that type of thing. And I think stablecoin will only build on that because of, as Charles said, the cross-border programmability, sort of some of these features that other forms of sort of digital money don't have.
Great. We have the question also from Lane is if someone is making a transaction between a stablecoin and Bitcoin, is this act going to be changing whether people get taxed on the capital gains for the Bitcoin?
So they're saying the person's asking whether if you transfer your Bitcoin to stablecoin, is that going to be a
Taxable event.
Because stablecoin can then immediately be transferred to dollars. It seems to me. I haven't seen the tax provisions of this yet, but my guess is that yes, that would still trigger a capital gain. But I'm guessing. I have not seen anything written about that question.
I think the current, usually any crypto to crypto transaction is a taxable event if there's a gains, whether it's a stable coin or not. Even Bitcoin to Ethereum, that would be a taxable event.
Right. And the bill does not address this at all, Lane. So that's just kind of independent of this bill. Now, separately, the president, I think it was just verbally the other day, was saying that there should be a certain low amount of like a transaction below $600 in Bitcoin should just not be considered a taxable event, and it should just be considered a currency transaction. You're buying something small. So those are the discussions that certain people are having, and it's not exactly clear to what the rules are and what they will be moving forward.
Yeah. Someone asked about the effective date, and I know that we're hitting to the end of our hour, but I thought it was worthwhile pointing out that the effective date of the Genius Act is the earlier of either January 18, 2027, or 120 dates after the date on which the federal banking regulators issue implementing regs. So it's going to be at least January 18, 2027, but it could be sooner than that. And then this is one of those layered effective date programs. When do you have to stop selling, stable coins that are not subject to this act, those kinds of things. But that's the high level effective date.
And so the speed at which regulators can do this is going to have to be calibrated by the amount they've been doged.
Yeah. Well, there's a lot of speed built into these things. If the regulations are supposed to be done within a certain number of days, if you apply for approval, that's supposed to be done within 90 days. Everything that's another overlay on this entire legislation is they don't want to be bogged down and slowed down by too much burdensome regulation. So they are trying to make this efficient. They're trying to make it fast. Now, whether it's going to, reasonably be possible, you've got agencies that have a lot less employees. How are they supposed to, get up to speed and get all these rulemaking done and approvals done in these time frames? That's going to be interesting to see.
Okay, great. I am a strong believer in smart contracts. Charles, you mentioned them, and I just want to make sure we all know what they are. But you program an algorithm to enforce code and enforce agreement. And so my computer has been programmed 60 minutes ago to explode if the Zoom call goes any longer than 62 minutes. I know David was encouraging me to have the discussion go, but I'm a strong believer in smart contracts here. So I think if it's okay, David, can we break up into the smaller groups as you
Yeah.
had proposed?
Yeah, absolutely. By the way, that means I look forward to any meetings I have with you because you'll be on time. Um, so thank you very much. This has been a fabulous discussion. Clearly, there's a ton of things to talk about, many, many things unresolved. Fabulous. We really, really thank you. Uh, and I mean, I said, this is morphing right now. It's going really, really fast. So being able to wrap our heads around it is only for the better. Anyway.